Hey there, everybody. Welcome back to Doc's Investing RX, where we diagnose your portfolio pains and prescribe the dose of knowledge you need to become financially fit. Now, to build upon the popularity of last week's podcast about option selling, today we're going to dive into one of my favorite income generating strategies in the market selling put options. And we'll crank that up a notch with put credit spreads. If you've ever wanted to make money in the stock market without needing stocks to soar, this one's for you. And with stocks making new all time highs, this may be a good strategy to employ. But let me be clear up front, this is not financial advice. Option trading involves risks. And while I'll do my best to break things down in a digestible and engaging way, you should always do your own research or talk to a licensed financial advisor before making any investment decisions. All right, stethoscopes off and thinking caps on. Let's get to it. So, before we run, we've got to learn to walk. What's a put option anyway? A put option gives the buyer the right, but not the obligation, to sell a stock at a certain price. This is called the strike price before a specific date. But we're not buying puts today, we're selling them. Okay. So that's like being the insurance company. You're taking all the risks, but you're getting paid up front for it. So let's take a stock like Apple. All right. Currently trading about 215 or so. You can sell the 180 put that expires in 30 days and collect $2 in premium. Every call contract is equivalent to 100 shares. So $2 per share is basically $200. So you get paid $200 to sell that put 30 days from now. So what's the catch? Well, if Apple drops below $180 by expiration, you'll likely be assigned the shares. So that means you'll have to buy 100 shares of Apple at $180 each. But hey, if you wanted to own Apple at a discount, right? It's 215 now, you're buying it at 180. So this might not be so bad. We will call that the wheel strategy. More on that later. So why sell puts, aka the premium life? Well, a few options, pun intended. Cash flow. You get paid up front. So whether the stock moves up, sideways, or even a little bit down, you still get paid. Control. You get to choose the strike price and basically how much you're willing to pay for the stock. And probability. You can sell out of the money puts that expire worthless most of the time. So you can see why it's such a lucrative and very popular way to go about making money in the stock market. Now, let's talk naked puts, that is. Okay. Now, what that means is you sell a put option without any protection. Okay. So if you sell a $180 put on Apple and Apple tanks to $150, you're still on the hook to buy it at $180. So that's basically a $3,000 paper loss, right? Because you're losing $30 per share. So again, 30 times 100. So why do it? Well, again, if you're comfortable owning the stock at the strike price that you put out there, in this case, $180, you have the cash set aside to buy the shares. And of course, you're okay with volatility. So what's the rule of thumb? Only sell puts of stocks you wouldn't mind owning. You're trading the chance of assignment for a steady stream of income. Now, I love Apple stock, and so selling puts on Apple is not a big deal to me because if I get assigned the shares, well, that's great. I want to own Apple shares anyway. Whereas if this is a meme stock, the last thing I want to do is owning tons of meme stock shares. All right. So maybe you're not ready to go full naked. That's where put credit spreads come in. A put credit spread is when you sell a put and then buy a lower strike put on the same stock with the same expiration date. This limits your risk. Example, going back to Apple. We sell the $180 put on Apple since Apple's currently trading at 215. I can buy the $175 put. So let's say cost was 50 cents for the $1.75 put. per share, and it's $2 per share on the $180 put. So $2 minus 50 cents is $1.50 per share. So I collect $150 in premium, right? And the max loss is the difference. So $180 minus $175. That's $5 per share. So the max loss is $5 times 100 shares is 500 bucks. But I got paid 150 bucks to take that risk. So actually my risk is $3.50 per share or 350 bucks. So why choose these spreads, right? It's a defined risk. You know what the worst case scenarios. If it drops below 175, I got protected. If it stays above $180, I keep all the premium. And if it's between $180 to $175 by expiration, then I may suffer a max loss. Now, another great thing about spreads, and the most important thing, lower capital requirements. So instead of knowing that, hey, I have to buy 100 shares of Apple at $180, that's $18,000 of cash money that you need to have set aside to buy it. Whereas if you have a put spread of say $5, that's only $500 that you have to set aside. So lower capital requirements is awesome and works great for most traders if you don't have a lot of capital to work with and you want to try this strategy. And of course, the psychological edge to this, knowing that your loss is capped, and that helps you stay rational, right? Prevents you getting too emotional in this trading process. So let's break it down a little bit. So here are some real world strategies that people use. I mentioned the wheel strategy. So this is where you sell puts on stocks you want to own. And say the market tanks and you get assigned. Well, now you own the shares at that strike price. And what you do is you start selling covered calls on those shares. So initially you sold puts, you got assigned the shares, and now you own the shares at a discount from when they used to be, but you want to get out of it. So you start selling upside calls against those shares and you rinse and repeat. And that's your income machine. So, example, you sell a put on Apple, you got assigned the shares, and then you sell calls on Apple to collect more premium. And say you got assigned Apple at $180, you can sell calls at $180, you can sell it at $185 or what have you until those shares get assigned to somebody else. Now, another strategy is the weekly income strategy. And this involves selling short dated puts, say 1 to 2 weeks out. The focus is on high probability, low delta trades, like delta 10 to 30. All right, this is boring, stable stocks or ETFs like SPY, QQQ. Um, Now, a bonus tip is, to use the IV rank, right? When implied volatility is high, the premiums are juicier. So, speaking of high volatility, the earnings volatility pop, right? If you sell put spreads after earnings on quality stocks, you get that post earnings IV crush, which involves premium decay. So, say Apple is reporting earnings later this week, I can sell put spreads for the following week. And once earnings pass, the IV crush will decay most of that premium. And that's cash money in your pocket, assuming that Apple doesn't tank, right? So that's a word of caution. Selling into earnings is a gamble. So if you want to be safe, play conservative, wait until after the fireworks and don't sell into earnings. All right, so let's talk risks because again, no strategy is bulletproof. We've talked about assignment risk. All right, you could end up owning the shares during a market dip, aka say Liberation Day that just passed. That was a brutal day for a lot of traders. As we crept up closer and closer to that date, the market continued to tank. And as these great quality stocks declined in value below market value, you led to increased margin requirements and again, chance of liquidation. So you can get burned pretty easily if you go above and beyond what your portfolio can truly handle. That's why cash secured puts, right? Having cash on hand is great. And we talked about put spreads where you have downside protection. So Another risk is that margin requirements, right? So naked puts tie up your capital or your margin. So having that spread, that downside protection can help minimize how much margin or cash you need on hand. Of course, we talked about gap down, right? So the market tanks overnight or black swan events, that can really be brutal. And of course, the emotional side of things, right? So you must be okay with being wrong. All right. So not every single put trade is going to go perfect, right? Sometimes the stock moves against you unexpectedly. So you have to be okay cutting loose sooner than later. Most importantly, don't oversize your trades, right? A few good trades can lull you into this overconfidence, but it only takes one bad setup to wipe you out. Now, the psychology of premium sellers is this: the strategy is like running a small insurance business. You win often, but your wins are small. Your losses are infrequent, but potentially large. So, what separates the pros from the blow up? Position sizing, managing your losers early, being picky, and letting the probabilities work over time, right? Your job isn't to be perfect, your job is to be profitable over time. So, again, choosing positions that your portfolio can handle. And if the stock for some reason moves against you and starts tanking unexpectedly or greater than you expected, cut it early. And then being picky has to do with choosing the right stock for the situation, choosing stocks that you love, that you enjoy, that you wouldn't mind owning. And at the same time, every day is not the right day to sell puts, right? You want to be able to organize your thoughts, deciding when earnings are coming up. Maybe the market is in a bearish trend and now is not a good time. Whereas if it's in a bullish trend, that could be a better time to sell. And of course, time, right? Selling puts, time is on your side. So every day that passes, the premium decay means more cash in your pocket. All right. So let's talk about how some traders incorporate premium selling. So 25 to 30% of the portfolio is used for selling cash secured puts. Now, this is just an arbitrary number that I've thrown at you. You can choose to do it with 5% of your portfolio, you could do it with more. But again, if you want to build long term wealth, ideally you start putting that cash to work and owning long term shares. Now, you can say that keeping these shares or keeping this money aside, you can put it towards covered calls, against those long shares. But again, you want to continue to build wealth. And that's the most important thing with this strategy. This is not just a event to make money, but it's also to build wealth. So again, scale it up or down depending on your risk tolerance and experience level. Start small, see how it works for you. Maybe you like this strategy, maybe you don't, but it's something to consider. So there you have it. Selling puts and put spreads. It's not flashy. It's not like a YOLO call or moonshot chasing like with memes and whatnot. But for the disciplined investor, it can be a steady stream of income, even when the market's just chopping sideways. And like I said, with the market pushing all time highs every day, this may not be the best time to be buying and going all in on stocks, but rather maybe buying a little bit of shares, right? Dollar cost averaging, and maybe considering selling puts at a lower strike price so you can get these favorite stocks of yours at a discount. So basically, you're not betting on rockets, right? You're just betting that most of the time the stocks don't crash. And that's what put selling is all about. And for that bet, the market pays you every single week. So just remember, know the risk, keep cash on hand, don't force your trades, and protect yourself when the storm comes. And that's it for today's house call. If this episode gave you some clarity or sparked a new strategy idea, be sure to subscribe, rate the show, and share it with a fellow investor. Want more deep dives into advanced strategies? Let me know, and I'd love to dissect it for you in a future episode. And as always, this is not financial advice, just some educational, strategic insights from someone who's walked the walk. The market doesn't guarantee anything, so manage risk like professional. Until next time, keep stacking that premium and investing with purpose. This is Doc. Take care.